Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges. Taking a look at another vol capture trade, kind of the last soldier of the AI parade standing, Dell Technologies, DELL, where still inflated implied volatility sets up for selling a long-term strangle to capture short-term profits, very similar to our previous few trades, especially the one on SanDisk. We're able to capture 100% gain on margin in less than 3 weeks. This one setting up almost the exact same way. As always, we like to use our fusion approach, combining fundamental, technical, and most importantly, implied volatility analysis. So let's jump in and take a look, shall we? First of all, from the fundamental standpoint, pulled off, this is on actually Monday's close, Dell price and sales now at 2.23 times, not quite the highest level over the past 5 years, but certainly in shouting distance. You can see over the past 12 years, Dell Technologies' highest price to sales ratio was that 2.37, hit just a few days ago, the lowest 0.15, but the median less than 0.5. We are now trading at basically 5 times the median, so certainly price to sales getting rich, to say the least, right? Further expansion may be difficult. PE ratio, same idea here, right? Trading at over 36 times, right? The max we have seen over the past 12 years was 37.5, so we're within shouting distance of the highest PE multiple ever. The median was under 13.5, so we're looking at basically 3 times almost the traditional, if you will, the normal PE ratio. So certainly valuations getting stretched. Earnings are coming early September. Will probably be out of the trade well before that, but be difficult to see them having a big enough earnings boot to justify, kind of like we saw in SanDisk, Micron, and some of the other names. We also like to take a look at the technicals, as we said here. Here is a chart on SanDisk. As you can see, everything kind of in neutral here, right? You see 9-day RSI hanging out around 50, MACD virtually flat, Bollinger %B mid-range, and we're finally seeing IV trickle down, especially from Monday's to Tuesday's close. I actually did a trade today on the opening. We'll take a look at it in a second. You can see Dell kind of having trouble breaking through that 485 level. Certainly 500 looks to kind of be a cap. So the technicals really just kind of flattening out here, kind of like the overall market generally, as we always like to do. Take a look at implied volatility. Here it is from Monday's close. Here's the 120-day excuse me, implied volatility on Dell Technologies. You can see hovering at the highest level by far over the past 12 months, finally starting to show some weakness, as we can see here across the entire term structure of vol. IV generally elevated, to say the least, 98th percentile. A slightly different metric, certainly at the 88th percentile. Taking a look at basically a shorter term IV, you can see it popped from under 80 July 14th to well over 90 at the highs, starting to creep lower here, right? Pulled off a call 360-day 60 delta call implied volatility. You can see that massive run up, like all the other AI related names, finally starting to slow down. We've seen this in Micron, in SanDisk, certainly in Storage Tech, and SMHs. We'll take a look at all 4 of those in a second. We expect the same thing to happen here. It's difficult to see a further expansion in implied volatility, simply given the huge run-up we've seen, and this is long-term IV as well. More difficult to really goose that too. So as we talked about, here is SanDisk, right, where we did that trade that worked out very nicely. Here's where we kind of sold the IV on SanDisk. that big reversion back down, right? Micron, same thing here, sold the IV, saw that reversion coming back down. Same thing here on Storage Tech, sold the IV, saw the IV revert, right? And SMH, more of an ETF, but you're seeing IV revert here. So across the entire space, big reversion. Dell, the last one standing, we look for that to pull back as well over the coming weeks. I took a couple comparatives off. One, a long-term December of 2028 straddle. The other one is strangle. I actually did the strangle. We'll take a look at it in a second. But here is the straddle trade. So going out to December of 2028, the 600 straddle, right, from the beginning of June, the stock was at 465. So the put was in the money by about 135 bucks. The call, well out of the money by the same amount, obviously. IV hanging in the low 70 area. You can see that sell straddle trading just over 450. You can see the delta on the put, negative 35, the call 66, right? So the calls, even though they're 135 points out of the money, carrying a higher IV than the puts because of the long-term nature and the comparatively high IV, both goosing the deltas up. Fast forward to Monday's close, we can see the stock a little bit lower, about 8 points lower, right? But we can see that the straddle actually jumped in price, right? Even though we were net short, if you would, from June 1st, right? And you saw the stock drop, you saw the straddle increase in price. Doesn't make sense. Also, don't forget about time decay, -8 here, -12 here, so about 20 cents a day in theta. We had about 70 days pass, so you'd expect the straddle to get cheaper as a function of time decay. Plus your delta short, and the stock dropped, you'd expect to get cheaper as a function of delta. But lo and behold, that straddle actually increased almost 18 points. So putting 2 and 2 together, June 1st, right, the stock at 465.96. That's 600 straddle, selling the call and put, trading at 452.5, -31 delta, 19 cents a day you'd make in time decay. IV just under 73. Fast forward to Monday's close, right, the stock actually dropped in price by a little bit more than $8. We saw 70 days pass, right, yet that straddle jumped almost 18 points. The delta actually became a little bit shorter. The delta on the call actually increased a little from 66 to 67, even with the stock lower and time passing. Why? Because we saw this huge jump in IV of over 6.5 vol points. So we would expect the delta drop, right, with the stock 8 points lower and us being net short deltas, right, we would expect about a 2.5 point drop in that straddle price, right? Time decay, that just marches on, right? About 19.5 cents a day. 70 days, we'd expect the straddle to be about 13.5 bucks cheaper. So we'd expect that straddle price, which was 452.50, to be under 437, but priced at over 470. So that vol capture of almost 34 points, all because of this huge jump in implied volatility. And that's that implied volatility that we look to come down, similar as it did in SanDisk, in Micron, in Storage Tech, and in SMH, also looking for that reversion in IV. Also took a look at the strangle, and this is the trade I actually did, right? So again, using June 1st as kind of our benchmark date, stock at the same price, selling the 500 put, a little further out of the money put than the 600 straddle, right? And the 640 call, right, that was the furthest out of the money call going back to June 1st. You can see that sell strangle now trading at just under 375 bucks and roughly a 72 IV. Fast forward to Monday's close, right, the stock again dropping about 8 bucks, and taking a look at the same put strike, the 500, but now the 700 call, right? So 60 points further out of the money, 60 points more upside cushion. That sell strangle, even with 60 points more cushion and 70 days passing and the stock dropping on a negative delta trade, right, actually increased by about 6.5 points. So that is all due to that jump in IV, which is now trading around 80. So putting those two together, right, June 1st, stock again at 465-ish, 466. That sell strangle, and this is the 500-640 call, right? Trading at 373.50, 35 deltas net short, about 18 cents a day in time decay. IV right in the mid 72 area. Fast forward to Monday's close, right? The stock did drop, as we said, just a little over $8, but the sell strangle up over $6, and this is with 60 more points upside cushion, not the 640 call, but the 700 call. So we got more cushion and a bigger credit. I always kind of like to do that, a little more safety, if you will, on that, right? The delta remained virtually the same, actually a little more theta, because anytime you get that huge jump in IV, you have that dual benefit of when you sell it, having more time decay heading your way. So IV jumped again about 6.5 vol points. So our expected delta drop, right, we'd be about 35 deltas net short, right? We saw the stock down about 80 cents. You'd expect that sell strangle, right, and this is the 500-640, to drop about $2.80. Time decay marches on, right? About 20 cents a day, right, for 70 days, just under $14. So you'd expect the 500-640 sell strangle to be priced at 357.06, but the 500-700 sell strangle actually trading at 380, as we said, 380.10 to be precise. So the vol capture of almost 23 points, even with 60 more points upside cushion. I like that combination of a little more upside cushion, certainly in this about 12% from a price perspective, right? And have a much bigger net credit. So fast forward to our trade from today. Here's the actual trade. Did it right on the opening this morning, selling the 500 put 700 call. Stock was down, right? So wasn't able to quite get that 380, but did sell it for a 375 net credit, right? Capturing that. 32 deltas net short on the trade, selling it at just over a 79 IV. Here you can see the margin requirement on selling that 500 put 700 call, just under $10,000. So doing it one time is kind of the trial in the account. And so far it's marking up about $10 on the trade as far as the close today, because the stock did drop, another benefit right of it, and IV did drop about 1 vol point. So marking up nicely. We'll take a look tomorrow, maybe a one-day trade, even though the option expires in December of 2028. The fact that you're trading super long-term options doesn't mean, as we found out with SanDisk, with Micron, Storage Tech, SMH, all of these trades have worked out nicely recently. Selling the long-term just means you have the latitude to hedge it if needed short-term until that expected IV that we have seen in every name but Dell comes to fruition. I would expect Dell to have the same move, and we can hopefully capture a very nice gain like we did on SanDisk. We will keep you updated. So that's how we go about identifying trade opportunities here at Delta Derivatives, or at Big Time Options. But as we always like to say, trading is all about probability, not certainty, right? You just never know in this market. That's why having a bigger cushion I am kind of in favor of, especially in this market environment. So you want to put on the hedge after you find the edge. But sometimes you just got to say, what the F, and knowing that this will end badly from that implied volatility move that we have seen always come back to earth. So until next time, as always, here's the good trading. Take care.